He was trying to educate and enlighten, cats. Of course, there's always got to be somebody saying some dumb shit when they don't really understand what the fuck is being spoken on. Um, so we're gonna just try to shed some light on the topic of when you're going out of the country, tax implications, right? How you could protect yourself and try to minimize that hit. We're gonna talk about the FEIE that he mentioned. There's also an alternative called the FTC. So I'm just going to kind of touch on high level side by side comparison of either one. So it says that the foreign earned income exclusion, FEIE, which is IRS Form 2555, the purpose is that it can exclude up to 130,000 as of 2025 of foreign earned income from U.S. taxable income plus housing costs. So that's what that does. That's the purpose, right? For the FTC, which is the foreign tax credit, which is Form 1116, it credits foreign taxes paid dollar for dollar against U.S. tax on foreign source income. It says no max, but it's capped at U.S. tax due. So now we're gonna move on to the next category of eligibility. A U.S. citizen slash resident, tax home abroad, plus bona fide residence, full tax year, or physical presence, 330 days, basically 12 months. So you've got to be in that new country most of the year to be eligible for the FEIE. And then for the foreign tax credit side of that topic, it says U.S. taxpayer with foreign taxes paid on U.S. taxable foreign income, no residency test needed. Okay, so that covers the eligibility for both of them. We're going to move on income types. So under the FEIE, only earned wages, self employment from work abroad, not investments or U.S. government pay. For the FTC, any foreign source, passive like dividends slash interest, general like rentals, wages, can't use on excluded income. All right, so now for the next category of limits and caps. It says up to 130,000 income exclusion plus housing. So it shows 20,800 base plus extras up to 39K plus, by location prorated for partial year. And that's under FEIE. For the FTC, it says the lesser of foreign taxes paid or U.S. tax on that income. Carryovers allowed 1 year back, 10 forward. So you got to dig a little bit deeper into what that means. But we're gonna move on to the pros of both of them. So for the FEIE, the pros are simple exclusion, reduces taxable income, good for low tax countries, housing perk. For the FTC, handles double tax perfectly in high tax spots, flexible for all income, no phase outs. The cons of both of them: strict abroad living rules, can't combine with FTC on same income, excludes only earned income, and that's for the FEIE. For FTC, complex baskets and limits, paperwork for proof, small credit shortcut, only for 300 to 600 passive. So, when to use, right? If you're living slash working abroad full time and want to skip U.S. tax on salary in low tax areas, that's for the FEIE. For the FTC, the foreign tax credit, it says if foreign taxes are greater than potential exclusion savings or for invested investment income taxed abroad. So filing, you would attach to your 1040, choose residence or presence test, and that's the FEIE. And for the FTC, one form per country slash basket attached to your 1040, and then you would, skip small passive amount. Pardon me. If you're living abroad for work, the IRS lets you skip U.S. taxes on some of your housing costs, like rent or utilities, in addition to excluding up to 130,000 of your salary for 2025. It's not unlimited, but it's capped. It's only for qualified expenses. Employees get it as an exclusion, reduces taxable income, while self-employed folks get a deduction, lowers adjusted gross income. You can't claim it if your housing is provided by your employer, because that would already be tax free. The goal is to help cover the higher costs of living overseas without double taxing you, but you must qualify for the full FEIE first, which is, of course, the tax home abroad plus residence or presence test. And then, of course, we go back what counts as qualifying housing expenses. There's reasonable costs for your main home abroad, which include rent or lease payments, utilities such as electricity, gas, water, trash, but not phone or internet unless it's bundled, property taxes, repairs, insurance, furniture rental. And that furniture rental looks real because, like I said, as I'm doing my research looking into this possible move, they got some plush situations abroad, especially if you like, want to hop off into some high rise situation. A lot of them joints is already laid out, you know, modern furniture, kind of trendy, all that fly shit. So I just had to throw that out there. So then parking or shipping costs for household goods, but that only counts once. So I guess if you ordering some shit, you better have that motherfucker shipped to your new country one time. All that shit in one bundle, nigga. Okay, so now what doesn't count as qualifying housing expenses? It says mortgage payments on a house you own. That's a deduction elsewhere. Improvements like renovations, meals or domestic help, cost for a second home or vacation spot. If conditions abroad are adverse, no safe housing, you might claim extras for a temp US style setup. So we'll move on to the next portion. So the key limits for 2025, the exclusion is your actual expenses minus a base amount of 20,800 for the full year, but it's capped at a max. It's prorated daily if you're not abroad the whole year. So that comes out to about $56.99 a day, base, up to $106 a day max. Location matters. Fancy cities like Tokyo get higher caps. So the base housing, the 20,800 number, you subtract this from your expenses first. So that should be about 16% of the 130,000. It's like the IRS standard rent that they would assume you paying. Okay, next. General max exclusion, 39,000. 30% of that 130,000 number covers most spots. Your exclusion equal expenses minus base up to this max. Location specific max. So it varies by country, of course. So 80,000 plus in high cost areas. The details on that, check notice 2025-16 for your city. If it's listed, use higher limit. For example, London might be 75,000. And then, of course, the daily rates, as touched upon, can range from basically $57 to all the way up to damn near $107 a day. So, how to calculate this all step by step. One, you would take the total expenses, add up all qualifying costs for the year. Two, subtract the base expenses minus 20,800. Three, apply the cap, lesser of that result or the max of your location, which is going to be probably about, I guess, 39,000 in general. Add to the FEIE, your total exclusion should equal income exclusion $130,000 max plus this housing amount. So, for example, you spend $45,000 on rent, utilities in Paris, and because it's a high location city, the cap for that city is 70,000. So now you have your 45,000 rent minus the 20,800, which should equal out to 24,200. Capped, no. So then you can exclude 24,200 plus up to 130,000 in income. So sounds pretty good to me. All right, so moving on. Obviously, what to do: list your foreign home address, dates lived there, and conditions where if the conditions were adverse. So if you was, I don't know, in goddamn Brazil, in one of them cities, that city of God shit, where motherfuckers is getting gunned down right outside your door, but you live in, where you want to live, you might be able to, I guess, get some extra points, literally, for living in an adverse, dangerous ass situation. So basically, the next step, you would total your expenses by category: rent, utilities, etc. Use the IRS worksheet for daily proration. Basically, expenses divided by 365 times qualifying days. So if you lived there the whole year, there's your formula right there. Then next, subtract base, apply cap, and get your exclusion or deduction if self-employed. All this shit will autofill if you're using some kind of tax software. Even though I would still recommend getting the motherfucking accountant. All right, attach and file. You would basically carry the total to the form 1040 line 8A for exclusion. File with your return. And as always, the deadline is April 15th, which would be April 15th for next year, 2026. So you got choices, you got options. It sounds like even though you may take a bold move of saying, fuck it, I'm out. I'm about to slide overseas, for a minute or for a lifetime. Either way, these are some options on helping you not get hit with the double whammy from a tax perspective. And with that said, I'm going to holler at y'all.